Good morning and welcome to the Saxo Bank Morning Call. It is Monday, May 13th, 2019, and we have a very odd, I felt, to close on Friday for somehow the market pulling together confidence that something was going to happen on the positive side in these U.S.-China trade tensions. Those hopes dashed pretty much over the weekend. I've got a selection of headlines here on this first slide. Stocks yuan decline, China retaliation awaited. I think that's one of the key points we're going to be looking at. What will China say? Gulf widens in the trade talks, and then we're talking about a non-solution. That was we had a podcast on Friday. I was interviewing our chief investment officer, Sten Jakobsen. He said it might be useful. He tried to put it in context. It might be useful for both sides to have a bit of a standoff here. We've had a big tiff between the two sides, and to have sort of a non-solution where they sort of retrench and figure out what they're going to do next. And there's immediate loss of face if either side sort of folds on the negotiating position. So that's interesting. Larry Kudlow also interestingly pointing out to Trump that who is paying the tariffs? Well, it's Americans that pay the tariffs. It's not China. The only way China pays tariffs is if demand is lower because Americans are having to pay so much for the tariffs. They have to order less Chinese goods. So what does this mean? The Chinese side, Peter, you were talking about this morning, some of the demands, the three demands they've put forward sort of to establish where their positioning, negotiation position is. Looks a bit difficult. I've got those three demands listed here. They have to remove those additional tariffs. I don't think Trump will be declining or climbing down from that. The target set for Chinese purchases should be in line with real demand. First of all, sort of having a line item, demanded purchase amounts seems odd in any sort of trade relationship.
It's impossible.
It's not possible, really, and it's not organic in terms of real supply and demand. And then the final one, the text of the deal should be balanced to ensure the dignity of both nations. That's a pretty soft one. Maybe you could check that box. Market reaction. We saw that very strong close in Wall Street. Futures are down 30 points the last I checked before we came in here to this morning call. So it gives you a sense of we were sort of trying to head positive, and there's been a bit of a hiccup here over the weekend. If we look at the Chinese session, I've got the CSI 300. We're in technical limbo below that huge break, which is way behind us now, 3,900 area. And we've sort of also fallen a bit there. Peter, you've focused on the next chart here, the KOSPI. We like to use South Korea as one of these leading indicators out in Asia.
Yeah, and for obvious reason, because they don't have the stock plunge protection team, as we like to call it in financial markets, which is what's going on in China right now with state funds being ordered to purchase stocks. So right now, I don't think the Chinese equity market really is a authentic parameter of what's actually going on. So we have to look for indirect exposures and indirect stock markets. So look for Japan and look for South Korea. And I like South Korea. If you look at the chart here, it's sending very stressful warning signals. I would say we're not that far away now from actually, erasing all the gains for this year. And as you mentioned, all in the news, I mean, there was some very dire straight news coming out of the semiconductor once again. I think sales down 30? Was it 30%?
Yeah, the first 10 days of May, there was a 33% reduction on previous year. So
which is at odds with what they've just said, Samsung and Hynix, that actually they're seeing a rebound. So a lot of confusion out there. And I actually think that also still the weakness of the Chinese market, I wanted to comment on that with Kudlow. Yes, it might be the American consumers that are paying, but I think, as you also a little alluded to, John, it's easier for consumers to cut back on buying all sorts of consumer goods, but if you're a net exporter like Germany and China, it hits you much harder. And that's also what I showed on Friday with my trade basket.
I think in terms of immediate cause and effect, the supplier suffers on the supply side more than the demand side. Let's look at we've talked about the Chinese response. That we haven't seen that Chinese response. There is, of course, far fewer in the way of imports to slap their own tariffs on. If you're talking about U.S. exports, or from the Chinese perspective, imports from the U.S. That leads to the key question, and I think across markets, especially in currencies, of course, would the Chinese yuan be weaponized or allowed? Not really even weaponized, but just as a weapon, allowed to float and devalue, which is this direction of least resistance. I've got a chart here. It's not. We all know that that big 7 level, which is the red line at the top of the screen, or the top of the chart, is the focal point. But a pretty big acceleration here over the weekend. This is the CNH. This is the offshore tradable version. The CNY has moved a little bit less. I would argue you've got a lot of movement in the Bitcoin market. It's above $7,000. So recall how far that is up from the lows, and we had a $1,000 weekend over the week. Just linking it with the news here, I wonder whether there's some speculation in the Bitcoin market about a Chinese move on the currency. Don't know. But if you look across markets, we have a lot of complacency. Peter, I was shocked you said the VIX was down to 16 at the close on Friday. 16 versus the highs above, was it 22, 23 last week. Credit spreads have come a tiny bit wider. They're hardly moving at all. People are using equities a little bit back and forth as the most liquid instrument to express immediate sort of fear on, risk on, risk off. But if the Chinese currency is allowed to move, I think that just is changed across the board. Of course, one thing that's moving, Ole, is on this, and for very practical reasons, is the U.S. commodity markets, because that is one of the spots where China can weigh in.
We've seen a lot of selling continuing here into during last week, and just take a look at this chart here. It went from bad to worse on Friday when we had the WASDE report out. These are some of the numbers in the top left. I think just for focus on the soybeans ending stocks. Basically, we're hitting almost 1 billion bushels at the end of this season, which is this summer, and then next season, which is running to next year, next summer, again very elevated levels. And you can see the surveys; they beat the surveys across all the different crops. So really, a nasty day for crops. Speculators, as we mentioned on several occasions, they maintain a record short. But just look at that chart there on the right. There will be some support sooner or later, but we're now talking $8 a bushel in soybeans.
But when we were talking about on Friday, there was some communication, sort of indirect comments that there would be support for the agricultural sector, sort of almost state-sponsored.
Trump almost indicating we'll buy these grains and send them off.
The only problem is with that is you cannot feed soybeans is not people feed, that's animal feed. So and it needs to be processed as well. So almost the same goes for corn. So it's
bluster and a bluff. Really.
It's a nice idea that $15 billion out of the 100 so-called makes on tariffs, he can buy grains from the farmers and send to a third world. It's not gonna work.
Buy and burn it.
Okay, let's hope not. Okay, we not a good segue here, but this is a data point I wanted to get in. We talked about these Chinese passenger car sales down almost 18% year on year in April. You brought a chart here, Peter.
It's just for the perspective here. So as you can see, it's China in the blue line versus orange and green for Europe and global. And as you can see here, the 3 months change is coming back somewhat, but there's a lot of variance in the numbers right now. But if you take the annualized decline in the first 4 months of the year for China compared to the first 4 months of 2018, it's down around 12%. And as I said to you, John, when you compare these numbers, look at the blue line. It's at around the bottom of where the global and European car sales were during the financial crisis. I don't hesitate to say that China was and is probably still in some form or some degree of a recession based on what we're looking at in the car market. So I think this is probably one of the best indicators we can track so far. As
long as it's available. Ola, for oil, it's really interesting to see here. We have all these hopes that U.S. and China are going to come together, and but there's not a lot of fear in the oil markets. We're not exactly collapsing.
No, exactly. And last week, just as we talked about, again, if you just look at this table, it's out on analysis.saxo shortly. This is the table I produce on a weekly basis. And generally, we can see that the change across the board was almost negative last week. The total net long now held by hedge funds across these major commodities hit a 40-month low last week. But just take a look at the top one. Brent crude is, we actually now for 2 weeks in a row seen a small addition to so basically funds are buying into this weakness we're seeing right now, and that's obviously a reflection of the fact that we are seeing a market which is continuing to tighten, and it raised the question of how much further downside we actually have in crude oil at this stage. Obviously a full-blown trade war, US announcing tariffs on the remainders of Chinese imports is a growth is hurting growth, but at this stage the market is really tight because of these voluntary and involuntary production costs.
Currency move as well, that would play in. That would be an interesting countervailing factor if we do see a UN slipping lower. I'm not calling that because I don't know what their thinking is, but that would be a... And
I think that's probably also one of the reasons why we've seen very lukewarm behavior in gold recently, because gold really should be trading above 1,300. It's not. The renminbi potential, the correlation to a weaker renminbi has started to kick in again. Another one of the commodities that we hit last week as well, cotton. It's also a major U.S. export product, so among the agricultural space. So really, market is being hurt by trade.
Yeah, so we're seeing. We mentioned overnight. The VIX was closed so weakly, but we've seen a pretty big injection of volatility over the weekend on the news flow. You've got a little perspective here on the Nasdaq. Look at those trading ranges.
This is not the Nasdaq. It's actually the S&P 500, but.
S&P, it's
nevertheless, it's the same.
The bars are the same. The recent few days bars are the same.
It's the same. As you can see here, we trading in the thin area sort of from the previous two sessions on Thursday and Friday. It looks very heavy technically. I would not be surprised to see the U.S. equities, at least in S&P 500, testing the 2800 area, because the downside pressure, I think, it will increase because there will not be any deal. So.
And then on Friday we had a close that was quite positive and an interesting IPO. This Uber IPO, which did not close well on Friday, certainly relative to the market.
No, it was downhill almost from the beginning. The IPO price was 45. It opened at 42. So obviously a lot of sell orders in the immediate opening auction. Took a couple of hours to clear that, and then it spiked to 45 at the highs, and then it just trended down almost 8% throughout the session. And I'm actually a little bit sad that not more Saxo clients actually read my piece, because this is what I basically warned about, and Lyft was sort of the precursor for that. And Lyft, in tandem with Uber, fell also around 7% to new all-time low. I think there's not a lot of risk appetite for Uber and Lyft at this point in time. It's a heavily loss-making operations, and it seems like if Uber is following the same strategy as Lyft, they're going to crank up their operating expenses this year to try to ignite some top-line growth, and it's going to be very expensive.
Yeah. So not a lot of enthusiasm there. And FX, incredibly dampened volatility. Again, I think there's so many eyes on that the Chinese renminbi and the degree to which that is dampening volatility. We have some weaker EM currencies. The commodity dollars within the G10 space have opened a bit weaker. The G3, euro, yen, and dollar, relatively firm. The dollar a bit less so within those three currencies. I've got a chart here of Aussie dollar just for perspective, and you can really see, I think that 70 level we have broken below, but it's not catalyzing big fresh losses. I think it looks to me like we need to see more profound risk off, or maybe even a move in the Chinese currency to unlock something there to the downside. I think from a fundamental basis, there's plenty of reason to talk up the potential for further downside. And Aussie, you're linked to housing, linked to the risk of more rate cuts, maybe even eventually QE to bail out banks in the ultimate end game there if the financial sector is destabilized. Let's look at our macro events for the week. A pretty full load for the rest of the week, even if today looks pretty quiet. Fed's Rosengrain and Clarida, both voters out speaking. We got a couple of big oil reports out later this week, and I've highlighted the Australian employment rate news. After the RBA insisted that so much of its policy is linked to the jobs market, that makes these jobs market releases potentially extremely important for Aussie crosses. And then I've added to the long-term event risks this G20 meeting that is being set up as the next key risk event for this U.S.-China trade negotiation process. So we'll all be watching that now. Unfortunately, another six weeks or so from now before we get there. A lot of risk of headline uncertainty. And I think it underlines our CIO, Stan Jakobsen's point that we could be in sort of a false stabilization period here. Certainly have a hard time predicting runaway enthusiasm to the upside as long as we're seeing this sort of non-deal situation between the two great powers on trade, at least until that G20 meeting. Or worse, we'll see what happens. In any case, we'll be back tomorrow with the Saxo Bank Morning Call. Thanks for joining.